When it comes to retirement savings, there's commonly three accounts that we discuss: the taxable brokerage account, the Roth account, and the traditional IRA or savings account. Now, again, Roth could be inside a 401k, traditional could be either traditional 401k or IRA. But the point is this: one is tax deferred, that would be traditional, one is after tax and subject to capital gains, which would be the taxable account, and the Roth would be considered tax-free. But there's actually another category, and that's what today's video is about. And this one is a combination of those, and it's called a health savings account. Now, when it comes to retirement savings, it's really hard to have your cake and eat it too, meaning get the best of both worlds when you put the money in and when you put it out, right? So if you're saving for retirement, you're going to have to defer those taxes, but they're still going to come due later if you're doing a tax deferred or traditional savings. The opposite is true for Roth. You're paying the taxes now so that you'll never pay them later. But the HSA, or the health savings account, is unique because you can actually defer it. It can grow tax-free and come out tax-free. So it has an advantage that those other accounts don't have. Today's video is geared towards those who want to retire early, and I'm going to talk about how to strategically leverage the health savings account as you approach early retirement and why it's important to make certain moves. I'm going to go over how you can invest the HSA, how it can grow for you, how you can reimburse expenses for you later, and how that will allow you to actually reposition money and prepare you to be as tax efficient and flexible as you can as you approach your early retirement. I'm Forrest Dutton. I'm the owner of Brightworks Financial Planning. I'm a certified financial planner, and I love doing these videos. I hope you enjoy today's. It's meant to just be educational. It's not personal, financial, tax, or investment advice, but it's to prepare you, those who want to retire early, to be as well positioned as you can as you approach this season of life. Hope you enjoy it. Let's talk about some basics of the health savings account. How does it work? What can you do with it? And then we'll move on from there and talk about investment strategy and reimbursements. So the health savings account is an account that can be utilized for anyone who has a high deductible health plan. And you can have either an individual plan or a family plan. Now, the rates for 2026, they're going to go up every year. So it's indexed for inflation. So for example, for this year for a family, it's $8,750. That's how much you can put in total if you have a family HSA. So meaning your high deductible health coverage includes your family. Now, what's interesting is if you get to age 55, you can actually do an additional $1,000. So that could be $9,750. And remember, the HSA, depending on how it's put in, many of you work for employers that actually will give you some HSA money. If the employer gives you the money, you cannot then go and deduct that, because basically a health savings account deductions that come out on your paycheck are actually deferral of your salary. So when you get your W-2 at the end of the year, it will reduce your wages by the amount that was put in by your employer. So you don't get an additional deduction on your taxes, but it does lower your adjusted gross income. So that's kind of how it works from a tax perspective. In addition to that, the health savings account, the money goes in, it can be invested just like almost like an IRA or a taxable brokerage or a Roth. You could put it in anything you want. So let me go into now why you might want to invest and how you might want to invest in a health savings account. So the mistake that most people make with the health savings account is they put the money in and they never invest it. You should invest this aggressively, especially if you're watching this and you're still under 50 or you've got 10, 20 years until retirement. Again, that's not personal advice. It's just a generally good idea. And here's why: because this account can grow over time. And we all know that healthcare expenses are going to inflate. The same amount that you paid to your doctor for a medicine now is not the same as it was 5 years ago. So you want to keep up with that medical inflation, because many people underestimate how much they actually pay either in premiums if they retire early, and that means most people are going to go through the ACA marketplace, or just healthcare in general. It's a large piece of the retirement income scenario. So if you have a health savings account, you can use that money tax-free to reimburse qualified medical expenses. Now, that's a pretty broad basket, so that can include anything from going to the doctor, getting medications, but it could also include things like if you are going to the dentist, right? So there are some things that are in there that you would think would not be. Over-the-counter medications count for this. So the reason I'm giving you these categories is because what you should do with your health savings account, if you're a high earner, is you should fund this account every year, and you should actually pay for those doctor visits, those medical bills, those over-the-counter expenses with your regular bank account or credit card, however you want to pay for it. Because the health savings account, what's unique about it is you can actually reimburse yourself in a later year for expenses that you made prior. So say that you spent $2,000 this year and $5,000 next year, and you just add that, so on and so forth, throughout your 40s, 50s, whatever it may be. When you get to retirement, that amount can be reimbursed tax-free. Now, at the time you do the reimbursement, again, you've already spent the medical expenses. As long as you're keeping detailed receipts so that you can prove to the IRS that you spent this on medical, you are actually just reimbursing yourself at a later date. Now, I want to go into how you can actually utilize that as part of your overall early retirement strategy. So we talked about investments, and I want to just, before we get into an example where I'm going to kind of draw on the screen, I want to talk through how might you invest the health savings account. I would argue, again, that you want to make this aggressive because the flexibility but inside the HSA is very similar to the flexibility inside a Roth or a traditional IRA or 401k. What do I mean by that? What I mean is when you have a taxable brokerage account, you are going to always be subject to some form of capital gains, dividends, etc. But when you have a Roth IRA or a traditional IRA, those by definition are deferred, right? So meaning anything that happens inside the account, you can swap out how aggressive you want to be. You can buy bonds, sell bonds, buy stocks, sell stocks. The HSA is the same. So I would argue for many reasons that it's easier to be aggressive, meaning when I think of aggressiveness, I think about if you're going to invest in something like a money market, that would be more the conservative, or cash. Aggressive would be all stock. So the health savings account, you can decide to invest or divest of certain stocks in there, but there's no capital gains. It will just go to cash, and then you can decide to reinvest. So just a word there that you can afford to be aggressive in this type of account, especially if you have a long range time frame. Now, if you're watching this and you're 50 and you go, man, I haven't taken advantage of a health savings account and I want to retire at 60, fine, you can still invest in that, but just realize that when you make investment changes, you're not going to have to when you make a sale inside that, you're not going to have to realize capital gains because it is still deferred until you take the money out, either for a qualified expense or not. Now, one word on the taxes. When you approach retirement, if you get to age 65 or older, you are no longer able to contribute to a health savings account. Now, there is a 6-month look back for when you opt into Medicare. So you want to be very careful of what you're putting in up until that age 65 because there are some nuanced rules. And secondly, after 65, this just transforms into a tax deferred account, meaning if you don't have receipts to substantiate the distributions you make, then you actually can pay ordinary income tax on those distributions. So that they're not tax free if they're not qualified distributions, but it would react very similar to a traditional 401k withdrawal at 65 or a traditional IRA withdrawal at 65. So let me just go ahead into a short case study and maybe show you how this might look and how it would fit into your overall early retirement plan. Okay, let's talk through an actual case of how this looks in practice. And this will help you understand the material that I've gone over so far, how it actually goes into a retirement plan. So in this case, our early retiree, Bob, is age 50. He wants to retire at 60. So he's got 10 years to work with. So he has a family HSA plan. Let's say he has a couple kids, he's married. He's putting in, as a family, $8,750 every year into an HSA through his employment in this case. So he wants to retire at 60. So over those 10 years, if we just take a conservative, he invests the money, it earns 5%. If you add that $8,750, and again, this doesn't even factor in the fact that likely he'll be able to add more each year, but that would turn into roughly $110,000. Now, over that same time period, Bob decided that he paid his expenses out of pocket, not with the HSA, and I just averaged 3,000 a year, not unreasonable, for 10 years. So that means of that 110,000, if we break it down, that there is going to be a portion of that that I'm calling tax-free other and tax-free qualified. Now, what's the difference? The difference being tax-free other, meaning, remember, as long as you paid those $30,000 on medical expenses, when you get to that 10-year mark and you have that 110,000 and the 30 inside of it, that means that if you needed the money for something else unrelated to healthcare, you could take it out and still it could be tax-free. Now hold on to that thought, because that's going to be important. What I'm going to show you, what I think is maybe a good decision to consider for that money instead of just reimbursing yourself. I can tell you how that can help you. And then tax-free qualified, meaning that $80,000 roughly is left over, meaning maybe Bob realizes he doesn't have to worry so much about healthcare and early retirement because he's planned for this. So one thing I do want to take home for you is a lot of people don't retire early because they're worried about healthcare. The health savings account is a weapon. It is something that you can save for so that you do not touch your other assets to pay for healthcare in early retirement. I think that's a highly underutilized strategy, and it should be considered for more early retirees. Now, this next section, I'm going to go one layer deeper with this tax-free other and tax-free qualified and show you how to utilize it as part of your overall financial plan. All right, let's continue this conversation and let's go one layer deeper. So we've done our due diligence, we've invested in the HSA, we've done it over time, we've kept our expenses, we know what our expenses were, and we're approaching early retirement. Now what do we do? How do we utilize this health savings account? This is what I'm calling a playbook for the 3 things you should consider as you approach this area of your retirement. Now, ideally, this would be 55 plus would give you the most flexibility in this area, because 55 is where the health savings account allows you to do a catch up. So in 2026, it would be 8,750 plus 1,000, so it'd be 9,750. So let's start with this. I'm calling this Reposition, Rollover, and Diversify. So Reposition, I want you to realize you have a strategic window here in order to do the reimbursements that you have kept track of, right? So I'm not saying you have to put it in a Roth, but what you see on the screen here is we have $30,000. What do we do with it, right? So what you could do is, depending on what your income limits are, you could either directly contribute to a Roth for you and your spouse. So in this case, that would be 8,600 times 2. But if it was just a single, it would be 8,600 per person. Or if you're weak on taxable brokerage assets, you could also reposition that money. So one thing I want you to realize is, even though you invested the HSA, the only thing you missed out on of that $30,000 is, right, it was $3,000 a year. There was no compounding on that $3,000. So this is the time for you to decide, how do we want that $30,000 to compound? Now, you may decide in your individual plan that maybe I'm low on liquid assets and maybe you need to put this in cash, or this is a money market fund. I'm not telling you what to do. I'm just saying this is the time that you need to reposition, and depending on what your situation is, you have options. The second is rollover. Okay, so basically this is IRA to HSA, okay? And this actually is a lifetime, one-time rollover. Most people are not aware of this rule, but it does exist. Now, when would you want to do this, and why would it be a good idea, right? So if you were retiring and you wanted to shore up that HSA for that final year, right? In reality, the best time to consider this is probably if you already have retired. So say you're 55 and you want to retire at 55. So when you are 56, turning 56 next year, you have IRA dollars. The deductibility doesn't mean as much to you, right? Because you don't have income anymore, or maybe you're just working part-time. So if you do an IRA to HSA, you can only do up to what the limit is for the year, right? And you don't get the normal tax benefit, right? So remember back in earlier, I said, if you contribute to a health savings account, it's a deduction from your adjusted gross income. It would not be in this case, but this does play into, what if you had 8,750 extra dollars that you know went in without coming from your bank account, right? It came from an IRA. Maybe you thought you wanted to do some conversions anyway. Well, in this case, it's a free way to convert that money, right? Because it came from IRA, which is tax deferred, to HSA, which is tax deferred and potentially tax free, depending on how it's utilized. So I think you absolutely should take advantage of the once in a lifetime rollover from IRA to HSA. How you do it, when you do it, that's what financial planners and advisors are for, but I'm giving you the playbook. Number 3, diversify. So in this case, these two are going to work together to figure out how can you diversify. So say you decided to do that 8,750 one-time rollover from IRA to HSA. And just one more thing about the rollover. Certain things apply, meaning you have to be covered by a high deductible health plan for at least 12 months after that rollover, or it will be then taxed and penalized. So those are the rules you need to know. But how does this play into diversification? So remember, if you normally contribute to a health savings account, it's coming out of your cash flow. It's coming out of your bank account, which you get paid for by your employer. Now, say that 8,750 is not being used. Well, then all of a sudden, that money can be put towards brokerage, CD, cash, high yield, money market, right? So whatever you need in your personal plan, you're able to diversify. So the health savings account, underutilized, and I want to finish with this. I'm going to do a final whiteboard on this. And I want to talk about inheritance, because usually people always talk about health savings and they never tell you that there's anything negative, but there is, okay? Here's the one negative. If you have a spouse and you are married, you can give that health savings account the entire amount and roll it over as if it's their own HSA if you were to pass away. But once they do, the beneficiary of that account, which would inherit it, would have to take it all out in 1 year, taxable. Okay? So there is so much to be said of too much of a good thing, right? So if you're 20 years old and you're maximally funding an HSA and you never use it and you're not married, well, you need to really think about that, right? This makes a lot of sense for married couples approaching retirement. Most people haven't funded this because it has only been around for a certain number of years. So I would say this is the only caveat and the only caution I would say is remember who it's going to, what your personal scenario is. You need to use this in your lifetime or your spouse's lifetime, which to me is another reason why what I just said makes sense, right? Utilizing the diversify strategy. So taking some of that money out to put it in either Roth or a brokerage, that would be the reposition strategy. That helps you to avoid this because it's not too big and you avoid then giving it to someone who then passes away, who then gives it to someone else and then is taxed. I really hope you enjoyed today's video. Please subscribe, please comment. I want to know, are you using the health savings account? Are you a fan of it? If so, tell me how. Have you thought about repositioning or rollover or diversified or any other strategies that I mentioned here? So please comment, let me know, subscribe. That's how I reach more people, and I will see you on the next video.